Hey, welcome back. China seems to be at the dawn of another period of growth with an important shift in policy that should allow them to boost consumer demand. However, Chinese stocks, including Alibaba, are still trading at some of the lowest levels in recent history, so let's look into them. I'll look into more Chinese companies in the near future, so make sure to subscribe and leave a like if you enjoyed it. Now back to Alibaba. They recently had some adjustments because they changed the way they charge merchants on Tmall in Q3, so they had to refund them. The cash flow is also affected by this change in working capital, but they can reach something like 20-25 billion per year today. That, for a 200 billion market cap, is quite an attractive ratio, especially for a tech company that's developing. But as you're about to see, this is more about the market's perception rather than how good the company is, which can change thanks to what's happening. They also announced selling a department store for a loss of 1.3 billion, and that one is indeed a loss. They bought it for this much and sold it for that, not just an adjustment in fair value that can jump again in a year. You know, the same as a portfolio. If you want to liquidate it, sure, it's relevant, but if you hold it for decades, it doesn't really matter. Financially, we see a very healty position, with the current assets covering the current liabilities and almost the total ones. They don't have a lot of debt, so there is room to get some 10-15 billion or even more, which could help in what they plan to do. We see around 150 billion in equity on a roughly 200 billion market cap, so a very good price to book ratio for a tech company. Sure, you have 37 billion in goodwill, but if you look at any US tech stock, you see around the same equity, but the market cap is like 10 times higher. Why I mention this is because unless they buy it, which they didn't, and include it in the goodwill, you can't have the websites, the apps, the brands and so on the balance sheet. So buying a company that relies on the online business for the value of the physical assets alone is usually cheap. So they are relatively cheap for a tech stock from almost any point of view, but this is first of all a Chinese company. Sure, they have and are developing the global operations, but you still can't invest in them directly, so you have to go through the whole VIE structure and, most important, the market's perception. This can be undervalued for a very long time if nobody wants to buy them. Sure, they can do and they do massive buybacks or pay high dividends and you gain a bit from that, but it's not going to be the full potential. If you want this to be a multi-bagger, you need either huge buybacks over and over to offset the lack of demand or a change in the market's opinion about China. The good thing is that both are possible, so this has potential. At the same time, if we compare them with other Chinese companies like JD, Pinduoduo and so on, we see that they aren't really the cheapest. I won't go too much into detail because I want to make a whole video about JD as well, and I already looked into Pinduoduo before, so make sure to check it out. About the buybacks, they also have quite a significant buyback program that they increased recently. At the same time, SoftBank, who made a ton of money from an early investment in Alibaba, finished selling what they planned to sell. We had a couple of years of constant selling pressure because they did some contracts to avoid dumping them all at once and basically destroying the price because it's probably more than anyone could buy in such a short time. So significant buybacks, no more selling pressure, plus a potentially huge opportunity that I'll mention in a bit, basically all happening now. A potential risk would come from tariffs. Before even entering office, Trump wants to hike the tariffs on Chinese goods and Europe also wants to fight cheap products from Temu, AliExpress and the rest. It's obviously a risk, but something like a 10% increase in tariffs, which means a similar increase in the price for the consumer, wouldn't really be that big of an issue. I mean, it's still very cheap. If it was more of a legal fight, so potentially not allowing US citizens to invest in them, as it is the case for a bunch of Chinese companies, sure, that would have been the very big issue. I think this is more of a political statement than actually a risk. Again, it likely goes back into the price and these companies would still have the best prices, so it's only more money to pay for the consumer. And don't think only about Alibaba and Temu. Walmart, Dollar General, Elf Beauty and probably anything we can think of, all of them rely on China. So if anything, it may be these companies that have to pay some of the tariffs together with the consumer and maybe a bit goes into the Chinese company's margin. Now, at the same time, we have the stimulus news from China. It's a package of rate cuts, even direct support for the stock market and pushing more money into the economy. China, like any other country, also had higher rates that are meant to slow down the economy, which has a direct effect on Alibaba. Now, cutting them combined with pushing more money into the economy should be great for the company, but it was maybe not enough for the market. We see the stock indeed jumping like 40% on the initial news, and now it's pretty much back to the same level as before. Is it a rational response to basically the most aggressive stimulus package since the pandemic? I don't think so. You have to remember that commerce and adjacent industries are usually very good representatives of the economy. When you stimulate the economy and especially the consumer, all the e-commerce, payments and so on should also benefit. Plus, starting in 2025, they plan to shift to a moderately loose policy from a prudent one for the first time in 14 years. We know what happened the last time they did it, combined with a recovery in global demand, and they seem to focus on vigorously boosting consumption, which is, again, amazing for Alibaba, JD, Pinduoduo and so on. How did the market react? At least as I'm recording this, it's flat or actually a bit down since announcing it. So I think there are quite a few very important things that may not be reflected in the price because the market is more focused on what's happening in the US and maybe underestimating or overestimating one of the two. They have a bunch of online stores that they plan to expand in Europe, the US and others. You have the classic AliExpress but also Tmall, Trendyol and I think Miravia or however you say that. This way, unlike Temu, they also target the mid and higher end markets while AliExpress and Tmall should remain the core of the business. And the thing is that there isn't really that much of a difference from Temu, it's probably the same sellers too. The main difference right now is marketing, so Alibaba can really take advantage of Temu becoming, let's say, obsolete, do some aggressive marketing as they are doing and take some market share. Prices and stuff are very similar or both are cheap enough that people don't really care about a few cents. What can make them different, however, is the fact that they are opening storage facilities in Europe, the US and more. They had this plan to offer 2-3 day deliveries, I believe, for some years now, and it might become possible soon. What they can also do is develop in other continents. There is huge potential for them in SEA, Africa, South America that can offer growth for more than a decade. So there are quite a few things to unlock some value and growth that are currently not getting the spotlight, I think, because of the market's focus on the US. But the market's focus can eventually shift, and with China, I think it's more about the country proving that it's investable again. We know that the companies are good and relatively cheap. What we need is knowing that the government can be somewhat reliable and won't use the companies however they want. Again, the companies, lots of cash flows, good financials, growth potential, but the country is the number one issue. If they were American companies, they would have been 3, 4, 5x more expensive. Now let's see a valuation. In a bad scenario, let's say they face significant competitive pressure and maybe there is a need for constantly higher capex. If they get to a cash flow of 15 billion, so significantly less than today, let's say the market keeps trading them at around 10 times that amount. That's a market cap of 150 billion, meaning a price of 62.81, so almost exactly the lowest level we've seen. That's a roughly 30% loss, so not terrible but also not great. In a second scenario, let's say they develop, but due to the higher competition and tariffs, they stay at around 20 billion. Have a bit of recovery in optimism from the market and trade them at a ratio of 15, and that's a market cap of 300 billion, meaning a price of 125.61. That's now a profit of around 50%, so not terrible given how this is still below the company's potential. They actually got close to this back in October, by the way, so definitely not impossible in the long term. But these have been relatively low ratios because of the market's opinion on China. If they get to 20 billion, so less than today, but the market is trading them at 25 times that amount, which isn't even much for a tech stock, that's a market cap of $500 billion. That's a price of 209.36, so not even the highest level we've seen, but a profit of around 150%. It can obviously be better, but even a conservative estimation gets a pretty good return. With global expansion and China's shift in policy, this can potentially do much better and become a better multi-bagger. So definitely an interesting one, and I actually bought a bit more recently. Strong financials, good margins, potential to develop, so definitely a company with potential. I think there are a ton of good Chinese companies that come at very attractive prices, but it's ultimately all about the market's perception. If they get to the 20-30x the cash flow we've seen before, these are multi-baggers by default on top of the potential to develop. The market's opinion won't change overnight, but constant developments, less worries about China, stimulus, and maybe a change in the VIE structure can add to the overall confidence. Until then, for me, this looks like a good time to carefully develop these positions at very attractive prices from a value point of view. But remember, there is obviously risk, so make sure you understand it. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.